And there's actually an inverse correlation between outcome to money raised. So, the expectations of growth and to deliver based on an institutional investor's timeline is not for everybody. And, that could be because the market's not there, the product isn't mature yet, and you haven't created repeatable demand yet to warrant that money. So all those things need to kind of come together. And we obviously are still long-term investors with 10-year horizons, but we typically model everywhere between 3 to 8 years in terms of when we start a partnership and invest to an event happens that creates liquidity for shareholders, founders, including us. And frankly, not all businesses are cut out for that timeline or the expectations in terms of return. And we are the most expensive cost of capital there is. So there's alternative ways to finance your business. That's typically like, why raise, why now, why does it make sense, and why you are sort of like the fundamental questions. And just because your competitors in market may have raised capital, it still might not be the right reason as well. Just thinking about this financially, you can have a lot more options raising less capital or finding alternative, ways to finance the business.
As a general partner at Edison Partners, Ryan Ziegler evaluates startups that have already survived one of the hardest phases of company building, finding customers willing to pay for what they've built. By the time founders reach him, the question is no longer whether the idea is interesting, it's whether the business is repeatable. In this episode, Ryan explains why most startups shouldn't raise money even if they can, how investors separate durable customer demand from vanity metrics, what actually makes a company ready for Series A, and why founder self-awareness matters more than a perfect pitch deck. We also talk about customer reference calls, leadership scorecards, founder coachability, and why companies need an operating system before they try to grow. I'm Walter Thompson. This is Fund, Build, Scale. Fund, Build, Scale is for anyone who's interested in learning the basic skills required to launch a startup, secure initial funding, and transform their idea into a sustainable business. Get the newsletter on Beehive or LinkedIn, and subscribe wherever you get your podcasts. And if you like what you hear, please leave a rating or review. Ryan, thanks so much for joining me today. I really appreciate the time.
My pleasure. Good to be here. Thank you, Walter.
For listeners who don't know Edison Partners, where do you usually enter a company's journey? When do you get on board?
Well, a little bit about us. We've actually been in business for 4 decades. We've raised 11 funds. We've invested close to 300 businesses and have the opportunity to exit around 250. We typically focus on first-time founders, serial entrepreneurs, and founding teams building bootstrap companies. We focus on technology and software-related businesses, primarily business to business. One of the hallmarks of what we do is we focus on underserved markets because we believe scarcity of capital can result in building better, more resilient companies. Like, we know that's incredibly hard. It's also why we think like there's a thing called founder magic to kind of build a business into existence with this profile. So within that, usually our companies are generating several $1 million in revenue, have product market fit with a set of customers in a set ed market. For myself, I lead our enterprise and vertical software practice. Been doing this 23 years. And just coming back to the point about this scarcity of capital, Walter, like, we define this as growth equity, partnering with bootstrap companies that are customer funded. We think that scarcity of capital really sharpens focus, effort. It typically drives a customer-centric culture early in business formation. And as a result of that, if you look at our funding landscape, like, a big proportion of our portfolio is now in less trafficked regions of the country where you could build great companies. So that'd be the Midwest, Southeast, Southwest.
And how do these founders arrive on your radar? What's the mix of outbound and inbound?
I would say the majority of it is outbound. We are actively building relationships, introducing ourselves, and building a relationship with folks over the course of 1 to 2 years. It's about 2 years average across our funds that we pick up the phone and say hi to actually getting an investment and a partnership done. So it's a while. And if you kind of think about it, usually every 2 years, there's either a financing event or an opportunity to do something in business, given the capital landscape of, seed investors to Series A investors, et cetera. So that sort of falls in line with also when it makes sense for us to sort of enter a business when they've gotten product market fit and starting to scale up, see demand in the marketplace, but are faced with a lot of operational issues in terms of how do you scale this and start to build up what's great about that founder magic in a scalable way.
I'm trying to put a sharper point on this episode than kind of how to raise a Series A.
Yep.
And I'm going back to something you said in our prep call. You said most companies probably shouldn't raise money even if they can. Why?
Well, something I've noticed statistically, so we have a huge data set of companies, and obviously we track how they got to where they are and the outcomes. And there's actually an inverse correlation between outcome to money raised. So, the expectations of growth and to deliver based on an institutional investor's timeline is not for everybody.
Mhm.
And, that could be because the market's not there, the product isn't mature there yet, and you haven't created repeatable demand yet to warrant that money. So all those things need to kind of come together, and we obviously are still long-term investors with 10-year horizons, but we typically model everywhere between 3 to 8 years in terms of when we start a partnership and invest to an event happens that creates liquidity for shareholders, founders, including us. And frankly, not all businesses are cut out for that timeline or the expectations in terms of return. And we are the most expensive cost of capital there is. So there's alternative ways to finance your business. That's typically like why raise, why now, why does it make sense, and why you are sort of like the fundamental questions. And just because your competitors in market may have raised capital, it still might not be the right reason as well. Just thinking about this financially, you can have a lot more options raising less capital or finding alternative, ways to finance the business.
How often is it the case that someone comes in trying to raise a Series A, but they don't have like a really clear, legible plan for how they're going to spend the money?
I think everyone has a plan and use of proceeds. The question then is when we sit down and really start to test the assumptions behind that plan, are they credible or not? And I'd say about half the time, they're very well reasoned, but the assumptions are off.
Mhm.
And that we can get into details, but that is everything from creating demand, converting that demand, how long it takes to implement, pricing, and how fast you can grow. And that's also based on the type of distribution model that you're trying to build. The big leap that happens with our businesses typically is like a founder or founding team can will it to, let's say, a $5 to $10 million run rate is super impressive. Then the question is like, can you build a repeatable go-to-market model, either direct, outbound, enterprise, or hybrid or channel, in a way that transfers sort of all the goodness of what the founders got customers to pay for at scale. And typically there's a little loss in translation, in that. And there's also a sort of a evolution of a sales process that's typically I would describe as like evangelical to consultative to then coin operated. And it's typically in that phase of evangelical to consultative. And
Mhm.
to hire those people it's hard. They're paid a lot of money, and you have to bring them in early in the process and really build the processes around that go-to-market build.
At the stage that where they're getting ready to talk to you about a Series A, how well do those founders understand their TAM compared to like a green seed stage founder who thinks they're going to get all of it?
Um, Not very well, to be blunt. But that's okay. More when we look at TAM, like when we analyze a potential opportunity or set of opportunities, we actually have internal scorecards that look at all this stuff that through all our efforts, we actually have 12 points that we kind of look at. And typically, we'd like to see 10 of those 12 points be achieved for it to sort of say green light. This kind of makes sense from a strategy and in a risk perspective. But within that is an analysis of TAM and really breaking that down into what's your serviceable addressable market now
Mhm.
versus TAM, because TAM kind of doesn't mean anything, honestly, because people
Sam
throw
and
out
Sam,
big,
yeah.
yeah, they throw out big numbers. So we'll try to work with the team to build up, a bottoms up model based on how you're selling it today, what's the average selling price, what's the demand you are seeing and what we think it would reasonably scale. With that said, we typically like to see at least market opportunities that are $1 billion in sort of addressable spend, hopefully growing at least 5 to 10%. And then the companies that we're engaged with, we want to see them growing faster than the market, which means they're taking market share. And you don't need to be all things to all people. We're very comfortable with niche markets because typically those companies earn the right to expand their addressable market over time with scale, and they become really, really special because they're expert at one thing, kind of own that, but they can repeat it, wash, rinse, repeat, and scale up the business to a pretty impressive level. So we're not turned off by, smaller market opportunities, but we have to see growth. Growth makes up for a lot of sins in terms of execution.
What are some of the unnatural reality distorting forces that capital can put on a founding team after they get to Series A?
When, well, I'll at least share um, when the product is not baked and you begin to layer on sales and marketing resources, that creates major issues in terms of technical debt, but a false signal in terms of what the market is actually buying.
Mhm.
And then, that typically sometimes leads to churn issues and having a leaky bucket, so to speak, in a business that's trying to compound growth is a big issue. So you start to build the operating structure against an assumption that's not true. And that happens a lot, and you have to be agile and pivot, but it comes back to making sure that the product is absolutely rock solid in terms of driving, durable growth and good clients and demand. And when that's not the case and you raise money, it exacerbates the problem.
Going back to the 12 points you mentioned that you're kind of in your sorting criteria there, how many of them, like, I'm not asking you to disclose all 12, obviously, but it's a mix, I'm guessing, of, is it database, is it metrics and like psychographics, is it metrics and vibes?
It's more, so it's actually more metric. So we have an operating scorecard for companies, and it's directional, right? There's not like one formula, everything's a snowflake, but given our focus, it's directional. And then we actually have a scorecard for leaders, CEOs as well. That's
Okay.
separate, but we look at them and it's in their entirety. And part of that, are standard metrics that you would assume. We just talked about TAM or SAM or SOM. Part of it is relative growth and the type of growth, then breaking that growth down into the quality of retention in the business, because the spread between um, gross and net dollar retention, if we're talking about business to business, like tells you a lot over time in the seasoning of those cohorts. And if there's a big gap, not saying it's a kick out, but there's definitely a story there that you need to understand. 100%, we need to see proof of transition of the go-to-market model from founder to at least a few reps that are actually producing, we would say, half of the new bookings to show that transition, and hopefully tackling a bottleneck that most organizations feel. We look at this is the point just made about product. Typically, we don't like to see it more than 30% of spend on just if you look at the P&L, but more what it says is that it's locked down. There's not a rewrite needed. And, we feel good that, there's always technical debt, but there's a manageable amount of that when, typically you had all these big monolithic applications that needed then get broken apart into services to scale up at this stage. We talk a lot about just the tenacity and decision making of the CEO, and how that breaks down in this scorecard. And then one of the rules of thumbs, is just this capital efficiency argument is like, what's the ratio of revenue you're generating relative to capital raised? And
Mhm.
and typically we'd like to see obviously that ratio be pretty high in terms of if you put a dollar in that, much more is coming through in revenue. And then the last thing I'll mention, that we've just learned over time, because we sit in this really interesting part of the market. We're not venture capital, we're not private equity, or growth equity. So we have a growth mindset, but more scale in terms of how we want to take and partner with the business to mitigate execution risk by providing operational value. I'd say half of our companies plus are still burning cash. They're growing quickly. A little less than half are not. And the founders have a choice whether, they want to raise capital or not, hence, a good fit for us. But typically, when we analyze a lot of data, we'd like to see burn rates below $5 million on an annual
Mhm.
basis, with at least two other factors. Um, Growth rates over 50%, if not higher. Because smaller numbers, you can obviously drive higher growth. Bigger numbers, smaller numbers, but that's okay on a growth basis. But the key insight is just a favorable positive working capital model. What we've learned over time is that if you have favorable cash flow dynamics of how your business is charging customers for your software solution, you're going to be in a much more enviable position that you have to have negative cash flow if you grow faster. So one of those three together has proven to be an interesting formula that all our winners demonstrate in the portfolio.
Let me jump in. Actually, I want to go back to that leadership scorecard. What's one line, one row on that scorecard that might surprise a founder they're being assessed on?
Um, Coachability. So, I would say, this is a very still, there's a lot of analytics, there's a lot of rigor in diligence and relationship building, understand our sectors, but it's still a personal business. Like I would argue, like I actually invest in people that are similar to me in some regard, because I think the style CEOs my partners invest in are slightly different and more cater to, who they are as both an investor and an operator. So we each have a slightly different um, uh, point of view, but it coalesces around a few things. But you know, um, I think we want high conviction, highly passionate subject matter experts that have lived experience. Love to see adversity, have to see adversity in your background. If there's failure, it's even better, because typically you learn a lot from that. It's humbling and it's hard, and people that are able to bounce back from that and rebuild. You see that in all our best operators across our portfolio here. And I think high ability to communicate, both verbally and written, is really important, because if you think about, like, the way I describe it, there's an X and Y axis, and up the X axis is like product domain and technical capability, and over on the horizontal axis is like financial acumen and delegation and leadership qualities. Typically, when we get involved, most of our founders are indexing up on high technical expertise, subject matter expert, and our job and our ability to help support them develop as a leader is smoothing that line out, so that their financial literacy, the ability to communicate and delegate, is actually the biggest part of their job. And that's kind of like the transition we see and work with them through as we go from 10 to 50 plus million in that journey.
I want to talk about kind of what needs to be true before a company is ready for a Series A round. In your assessment, kind of give listeners a practical self-audit. But I mean, product market fit means a lot of different things in different cases. Generally speaking, what does Series A readiness look like from your side of the table?
Um, I think there's a semblance of a senior management team here. It doesn't need to be fully built out, but a demonstration that you're able to hire and recruit some talented people to come into the business to follow you. That's a huge leading indicator that they also see the opportunity. You're able to articulate it to them. They're excited about joining the business. With that said, the adage is like you give control to get it. So stylistically, letting those people then run their respective organization while you're driving, key initiatives as a CEO, just in how you show up, how you present yourself, how you describe the business, and let I would say the few folks on the team, whether they be in the ELT or SLT, kind of do their things. For us, it's easy where we sit, honestly, because like we just call customers. So we'd like to see at least half a dozen customers. Usually there's a couple dozen. And we hop on the phone with them and listen. And you'd be surprised about like what you learn.
What are you trying to find out in this customer? I mean, other than does it work and are they okay to work with? Like, what else are you trying to learn in those calls?
Well, I mean, like the fundamental question is like, will this product or solution get this person promoted? Because that's the difference between I would describe a vitamin and a painkiller. And that's not, it depends on the level of folks that you're talking to, but you can clearly understand quickly how important on a scale to the job it is at hand, and whether there's then an opportunity based on that service level and that client relationship if you can provide more value, upsell, cross sell. Would they refer it to other peers? Your best customers are your customers, right? Or your best prospects are your customers referring them. Um, those are the things that, obviously a lot of discussion around ROI, relative value, and what they're doing. And we don't do this in a vacuum. We understand these are busy people with a lot of responsibilities. But those are the questions. And again, we're there to listen more than ask, and you'd be surprised they sort of open up pretty quickly about the decision-making process, the criteria they use, the rating scales, the forward view on, how this gets implemented and where it could go. Those are all the points we're trying to get our heads wrapped around about how repeatable this is, how durable it is, and can we grow within a client account. One of the things that I think about is, if you have your current install base, could you double the business just on your current clients? That's usually like a really great sign that you're building something of high value versus a point solution that's going to be probably a pretty tough slog.
What are some of the things that a customer might say in a call that would make you not want to do a deal?
Um, well, uh, the easy one was I would say opaqueness around how they justify the spend. So if they can't tie it to actually metrics in their business or tangible value, it's not to say it's not there. It usually means there's a lot more work to be done, and it's sort of a reflection also of when you sell a piece of software or solution, there's a mutual value exchange. Say, we are solving these goals for you. Let's revisit those on a monthly, quarterly basis in terms of our onboarding and success teams as well. And more companies, some companies are more mature than others in doing that, but typically the ones that really are customer centric can articulate those easier
Mhm.
and just point solutions that we see out there that have high risk of either going out to bid or churning. And one of the questions we always think about is when times are tough, is the CFO going to cut this? and what is this relative person's, the client, position within the organization, influence, and workflows is it tied to? Because we've seen that across a lot of industries, through different cycles of solutions getting cut pretty quickly.
I'm trying to keep things positive, but like, what are some of the things that founders might do to mask the fact that they don't have durable demand yet? I've worked in places where people are like, yo, let's look about, let's talk about MAUs and not average daily users or things like that. Like, what are some of the things that kind of jazz hands, for lack of a better word, that you've seen people do?
Um, I think um,
I
usage.
mean, I'm sorry. I'm trying to basically figure out like what are the lies founders tell themselves before they go out into the
Oh,
market, and if that makes it simpler, I'm not sure.
um, well, contract structure matters a lot. So, pilots are pilots, contracts are contracts. So when you talk about revenue, bookings, and things of that nature, like you got to be crystal clear, or you lose your credibility really quickly, about how clients are actually buying or trying out the solution. And if it's a bunch of pilots, that's fine. We have even companies that have someone use it for free, with the expectation in 2 months or 3 months that we're gonna sign this contract that we're negotiating right now. But it is not um, clearly articulating how customers are buying or lack thereof the solution that can quickly unravel. Yeah, I think uh, usage metrics and MAUs, things like that. Yeah, that's fine. It's more vanity. It's someone willing to procure the solution and buy it, and then on what terms. Is it 6 months, is it years, is it multi-year? Those are all different ramifications. And I think the other um, thing here is like how much pricing power do you have? Gross margin is like a relative value of what you deliver to your clients. And if you're able to actually increase prices, that speaks volumes. So, again, we can see this within the data when we look at sort of, how cohorts kind of play out over a book of business.
I do want to pivot a bit and talk about founder maturity and investor fit. Something you said in the prep call, you can tell when a founder when they want money versus when they're actually looking for a partner. What are some of the tells? I mean, I think everybody wants money, which is why I'm kind of curious about this.
Um, you can tell if someone's actively listening or not. In the questions you ask, um, in the follow-up and access to their team, as well. I talked about that before. Those that certainly you want to sometimes control narrative or be coordinated. I get that. But having the confidence to let an outside investor or partner speak to your team without you in the room, that's big. If you need to be part of every single conversation, that's usually not a good sign. Um, so it comes down to sort of like the centricity around like decision making with the founder, if there was any bottlenecks, um, and the team around them.
What do founders do that make you trust them more off the bat then?
That's a great question. Um, I'll actually, yeah. So they're highly self-aware, and we have a very open conversation around what they like working on, what they don't like working on, where they need help, where they've made mistakes, and how they're trying to improve it, and actually come to the table with us to say, here are all the things that aren't working in my business. Like, what do you think about this, and how can you help me? We might not have the answer, but that level of maturity, that level of transparency creates immediate like, I want to go work with this person, because it's showing how they'll collaborate and partner when, you hit, the bumps in the road, because nothing's a straight line in their business. It's definitely volatile and a lot of near-death experiences along the way. So like good news needs to travel, or bad news needs to travel fast and first. So those are really important tells. And just the investment most recently was a part of it and made. I'll tell you a story. This gentleman, he has been running his business for a decade, had a lot of ups and downs, and really started to hit an inflection point with there a lot of hard work, refactoring their platform, and it's getting great scale. He was doing too much, and his board said we should hire an investment banker. Okay, because that's happening a lot, definitely a lot more in early stage technology these days for a lot of reasons. But he said no, and his point was whoever I go to partner with, I want them to understand everything that's working and not working, and still want to work with me. So it's a two-way street, and that level of maturity and transparency like goes a long way.
What's a question you wish a founder would ask you during a discovery call that they don't tend to ask?
Uh, what does success look like for you? They just assume, we put money in and want a big return. I think every firm out there is different in their approach, where they are in the portfolio, what they look at from a risk return perspective. So like we have, an internal model and portfolio model, and we actually are super transparent, share that because we need alignment. And, hey, that determines kind of in the beginning of this conversation, Walter, like the amount of risk you want to take, the timeline, the degree of difficulty to like build this thing based on the multiples people are hoping to underwrite if they invest in the business, and can the team, the market, and the model support that. So like I would argue most my venture peers are shooting for really big outcomes on a multiple basis. And that's great, but that's also because of, venture economics with higher loss rates. Given where we sit in the world, our loss rates are much lower, which affords us to actually look at a return distribution that's a little bit different. Venture or power laws still apply to our business. We still want that really big, outcome, 10x plus. But there can still be life-changing events for the team and really great outcomes much lower than that. And that's actually what we underwrite for because, 85% of all M&A is below $300 million in enterprise value. Most deals don't get done under that. So like, how does that math work? Right. So like as an entrepreneur, you need to think about that in terms of like, we have a portfolio. You have your life's work you're working on. Like let's talk about how how much risk you want to insert into that equation and talk about even if it doesn't go up and to the right, what could happen on here that we could optimize for a great outcome with everybody along and create value. And it's a constant discussion around how much risk, the capital formation strategy you want to take in building the business.
You talked a few minutes ago about what fosters trust. And I guess, for lack of a better word, it seems like you were kind of talking about vulnerability in some small way, kind of like opens the door to that a little bit. I live and work in Silicon Valley. And so it's I'm going to call it generously, a very ego-driven environment, where I think people who want to model success, they model that behavior. Is that a tension for you as an investor, seeing like people who are unreasonably cocky or high in their own supply and they're kind of floating above like the floor a little bit when they really shouldn't be? I mean, is that something you have to deal with, or is that something you just factor into doing business with people, basically?
That's typically a pass for us. Listen, there's 100% all our portfolio leaders are high functioning, super ambitious, smart, capable people. How you show up though is a little bit different, right? They are willing and creating markets, but how they communicate with their stakeholders, I think, is is a lot different. Yeah, most of our conversations once we're in together are heavily related to the organization and what's not going right in the business that we can address. But yeah, we have to break through sort of that veneer and if we're going to work together. And there are certainly folks out there that don't need our help, and that's fine, and just want to take the check and run the business and control it, and that's just not a fit for us because if things go wrong, we're not in an ability to actually step up and help meaningfully, and we'd be doing a disservice to our investors in terms of how we describe our strategy and where we think there's value creation.
I think you mentioned you're doing kind of it's growth equity, and
Mhm.
it's not traditional VC model. Do you lead, or are you the only person in on these rounds?
We lead in all the rounds that we invest in. We're not the only person in these rounds. In some cases, there's certainly situations where there's earlier funds or angels within there. We would describe it as the first larger institutional shareholder of influence. Typically, we're the largest shareholder in the cap table that doesn't control the business outside
Mhm.
of like the founding team. So as a part of that, a lot to do, around best practice and board formation and governance and reporting and just how do we scale up this business so that if the founder can go on a vacation, it can still run um, and scale. So it's not specifically about succession, things like that. But it is creating the environment, for the business to really get to a level, I'd say, 2 to 5x from where we started in a 3 to 5 year time frame. So the only way to really do that is, implement the correct processes and operating systems to do that. So one of the areas we spend a lot of time on is, what's the operating system that's in place to help scale this founder? And in a lot of scenarios, there isn't one in place, and that's fine. And before a lot of our discussions, we start to talk about this, and it's sort of like, well, what does that mean? And I can run through that, give some examples, but also like, what's your support network to talk through this outside of us as well? So, as a part of what we do, we have operating partners focus on organizational leadership
Mhm.
and health. And how do you, in your role as a leader, show up and change over time as you go from 25 to 50 to 100 to 200 employees? Because it's a vastly different proposition at each of those hops.
How do I do a fit check to see whether I'm ready for a Series A? Um, so for someone who let's say they think they might be, I don't know, let's say 6 to 12 months away from trying to raise a Series A, what should they be auditing inside their business right now today?
Um, I think a couple things. Certainly creating what I would say is like a customer catalog, a data cube, around their customers, the contracts, and then the metrics around those customers. Like the first thing I'll ask after, we start talking about a business and getting to know the team is like, can you please send us your revenue by product, by customer for the last 2 years, by quarter? And I just want to see that and see what patterns come out of that. Like at a second order function, yeah, we can ask for retention data and we can ask for usage data. So like just thinking about how do you document the reporting around your customers. And again, to your point, like it might be more usage than actual contracts. That's okay, but at least you can show that in an intentional way and talk about what's happening within the business and the demand to prove out like these milestones is pretty important. I think having good service providers actually matters in terms of you don't need to be audited. Some companies mostly have a financial review, but having an attorney that actually is in sort of the growth business matters to give you to make sure things have been cleaned up on the corporate structure, legal, options side. And I think, yeah, on the product side, um, if there's technical debt, that's fine. I think then put together a plan of what you think you need to do to address it, and talk about the scalability of that system. And we're in a really interesting time, right? Because of the infrastructure shift to agentic, but we still have a lot of, I would say, older software that was built that was out there over the last 2 years that's going through a lot of transition. So there'll be definitely some questions around the architecture and scalability. But I think most of it, and most investors at this stage are looking at customer demand and what's happening with the buying and use of your product. So like that, again, customer revenue data is probably the number one thing in my mind to having good order. And then just getting in the habit of like monthly or quarterly updates, or anyone that's showing an interest in your business. So if you want to put together like a friends and family newsletter, I get it all the time. It's fantastic. And it kind of runs through like, here are the highlights, here are the lowlights, here are the milestones that we achieved, here's the progress of the business, and here's what we need from you if you're willing to help us. And just creating that dialogue on whatever cadence that you can handle it to express what's happening in your business, I think goes a long way. And I read every single one of those that comes in my inbox for those that are willing to send it.
So I want to ask about runway. Like I know it's got to be all over the map as far as runway, but my sense is that at the seed stage, like most people I talk to will give me kind of a rough ballpark of maybe around 18 months for you should have at least this much in the bank if you're at seed stage. Um, we're talking, but you're coming in and you're trying to kick off a growth stage here. That's a different scale. What's your is the I know it's got to vary from founder to founder and product to product, but generally speaking, is it longer than 18 months as far as that runway, or does it how what's the minimum, I suppose, for going into Series A? How long should this plan to last me? There's a lot of plans that need to be executed here.
Yeah, the world's changed a lot over the last couple of years on this, just in terms of like, growth versus profitability. And we sort of went between the two. Now we're coming back to growth a little bit, in versus just, you have to drive to sort of a profitable level. The quick answer is like at least 2 years. And then you want to create all your um, uh, achieve all your milestones in terms of either scale, customer proof points, rolling out sort of product milestones in those levels, for perhaps a Series B, and or what I would say is have then in addition 6 to 12 months of runway based on your operating burn in addition to that plan. So that might manifest in another 6 months plus of capital. But that's and the old adage is like whatever you need, double it. That's easy to say, but and we would provide a lot of rigor around that to say, why do you need that much? And let's talk through it. But like those are um, legitimate answers, just based on market volatility or just where the stage of the business is. And as an investor, I want to make sure there's plenty of runway because Murphy's Law always hits. And you have to have enough capital to figure it out before you either raise the next round or drive it to a sustainable level.
What's one experiment a listener could run in the next 30 days or so to kind of just see whether they're actually are ready for Series A at this point? What's the strongest way they can kind of just fit check themselves right now?
I'm going to steal this from a chairman of one of our companies who's just an unbelievable operator. He has an acronym called NIHITO. Nothing interesting happens in the office. So to your point, field research, customer surveys, like 100 of them. Go out and just talk to people, document it. Then you can put it against a feasibility matrix. You can put it against a feature matrix with like whoever's out there from a product perspective. If you're doing the primary research and out in the field, that is the best way to spend your time. And from a diligence perspective, as we engage, it just makes for, I'd say, a higher probability outcome.
Ryan, this has been a fantastic conversation, super actionable, super tactical. Thank you for the time and perspective. I appreciate it.
Thank you, Walter.
The Fund, Build, Scale theme was written by Michael Tritter and performed by Michael and Carlos Chairez. Michael also composed Ocean, the track you heard at the top. If you enjoyed the episode, please subscribe and leave a rating. It helps more people find the show. You can get the Fund, Build, Scale newsletter on Beehive, follow along on Instagram, and if you have a guest suggestion or a question, reach me at fundbuildscale@gmail.com. Thanks for listening. Fund, Build, Scale is a production of Truth and Soul Media, LLC.